Good afternoon, everybody who's dialed in. And Manish, we are absolutely privileged to have somebody of Manish's stature to join us. We hope to cover a few topics, get Manish's insight into the markets, how individuals should behave, what is the recovery scenario. It's interactive in the sense that I'll ask the questions and Manish hopefully will give us the answers. I might add a bit of my point of view. And you guys can, the team is collating all your questions, of all the participants. And if you're not able to answer the questions in the session specifically, be rest assured that we will get back to you individually with specific answers. So please keep putting your questions in the chat window. I'll introduce myself. My name is Atul Shinghal. I am the CEO and founder of Scripbox. We're an online wealth management platform. I'm, as they say, one of those overeducated, underpaid guys. IIT Madras, 91. I am Bangalore, 93. Lots of work in corporate life, and I've been an entrepreneur for 10 years now. Scripbox has been a very beautiful journey for us, but we'll come to that later. Let's know a little bit about Manish. Manish, if you can tell us a little about yourself, about your education.
Yeah, actually a bit similar. Over-educated and underpaid. Basically, I grew up in Hyderabad. I'm the son of a doctor, and I went to IIT Chennai in 1990. 94, I passed out from there and went to IIM Bangalore, 94 to 96. So after that, I was
not dragging you. I'm surprised. I should have caught you on campus itself. Probably different hospital area. So tell us a little bit about your career, Manish. What did you start with? How long have you been in fund management? And what attracted you to the field?
Yeah, so it's interesting. As I said, I was a son of a doctor, and my interest in stock market started when I was doing engineering. So basically, in one of these summer holidays, I went back home to Hyderabad from Chennai, and my father made me do some filing work. And the filing work was predominantly those paper certificates, the share certificates we used to have, if you remember. And I saw some of these share certificates of Glaxo Pharma. Because my father was being a dog, he was given shares at 10 rupees in 1977. At 10 rupees, he was given 17 shares, which basically on 170 rupees. By the time I was filing this in mid-90s, that value had become about 2 lakh rupees, from 170 rupees to 2 lakh rupees. So my interest was started then that if it's so easy to make money, why not follow this route? It's got numbers, which as an engineer you relate to. And being a bit of an introvert, it's nice to just feel that you can make money without going and marketing and talking to people. So I did a summer's course in stock market when I was doing engineering. And then from there, obviously, because academics and engineering was not exciting, I didn't want to go to US. So I went to IIM because that's where they teach you finance at that point of time. And I did finance there. I started with prime security. I was lucky actually because I graduated in 96, which was a downturn in the economy at that point of time. A lot of these leasing companies had gone bust, and the usual slowdown kind of environment where people were not getting jobs in finance. I was lucky that I got into prime security, which at that point was a fairly hot company. And I was really blessed that some of the analysts who were there in that team, they're still my mentors today. So we really had a very good set of people there. So from there till 2000, I was in the stock market, first in prime securities, and then a version of IDFC, which was called SSKI then at that point of time. Then what happened was my life has basically rotated between entrepreneurship and financial markets. So a couple of my IIT batchmates had started a software product company in Hyderabad. So I went there, worked there for 4 years. It did not scale up. I came back to Bombay, worked with my ex-boss, Ashish Kacholia, who's a fairly well-known stock market guru in a sense. So I worked with him, worked with Lehman Brothers when it collapsed. Went back to that software product company for a year after Lehman collapsed because they had got a private equity round of funding. Again, I realized that was not scaling up. Finally, I ended up on the buy side in the PMS division of ICICI Prudential MF. And last 10 years, I've been doing buy side. Moved up from PMS to MF on MF side in ICICI Prudential. I'm lucky enough to run two very good funds, ICICI Blue Chip and Balanced Advantage Fund, which together are probably about 40,000 crores today or something. Then I moved to Nippon, early called Reliance, a couple of years back, yes. So in a very short summary, it's a very volatile career.
No,
So it takes a lot of time.
No, but lovely to hear you how you started and this whole belief that that this is a great place to make money if you're just patient and know the numbers.
Yeah.
Tell us about your investment journey. What all have you seen? I mean, you've been here for such a long time, so you've seen the ups and downs. You've seen different times. So just tell us a little bit about your insights about markets in general.
So one of the things, I don't know, it's a blessing or a curse. I've been involved a lot in bubbles. So when I started my career, I was a software analyst. This was in 1996. And we all know Infosys, Wipro were all coming up at that point of time. So I saw Infosys stock while I was covering it become 100, 200x from 96 to 2000. Then I saw that 100x becoming to 10x because it fell so much after that crash. So got a very steep learning in terms of boom and bust. Then when I went to Lehman and before that with Brick Securities, I started working on sell side in 2006, and coincidentally I was given the real estate sector. And that was a time when DLF again was 100 bagger, 200 bagger, God knows what. And then when the bust came, all of these stocks again became 100 of what they were. So I've written reports on Infosys in 2000, DLF in 2007. So in that sense, yeah, there's been a bit of a crash learning in terms of investor psychology, if not anything else.
So that leads to the next question. Sorry, which has been to relate to this. Given that you've seen this before, what do you think, or what is your estimation? Is the shape of the recovery likely to be? What are your expectations? Is it similar or different to things you've seen in the past? What are the factors you're looking at to sort of to discover the recovery?
See, as they say, history rhymes but never repeats. I think this is a very different thing which none of us have seen, to be honest. So maybe if I take a year or two, the total output loss, GDP, whatever you mean by it, is not probably very different from the financial crisis. But I think it's that acute pain for 3-6 months, which is even much more than GFC, right? Because if you go back to the financial crisis, you would expect that a business whose sales was 100 would see a situation in a big financial crisis where sales became 60 or 50 or 70. You would never expect to see a situation where sales goes from 100 to 0. So what I'm trying to imply here is that for a fairly short period of time, maybe 3 to 6 months, but the pain is so intense for businesses in that period of time that I think the debt word itself will become a 4-letter word. People see, difficult to read how long the psychology will go on, but I think debt and credit will be very seen with a lot of care and caution. Which globally, while central banks, as we all know, have been very active, pumping in a lot of liquidity, a lot of leverage has happened all across the globe. But I think any business which lives through this time, who's got debt, will remember it in their psyche for a very long period of time. I hope the government comes up with reasonable policies, because I really fear. Okay, my worst case scenario, the thing that really keeps me awake at night, if at all, I'm kind of a lazy person, but very few things keep me awake at night. But I really hope that the things we read about that Great Depression 1929, one of the big factors there was a string of bank failures, the small banks failing a lot. I just hope that we don't end up in that situation. But I'm a bit more optimistic about the recovery. I think as long as the government takes reasonable steps, as long as the number of cases, I think India will handle the key virus pretty well. But what I feel is that it this scenario will essentially lead to a massive consolidation of profit pools, which is why I'm quite optimistic on the market actually. Because as I said, the pain is going to be for a fairly short period of time, maybe 3 to 6 months, the peak pain. And two is, see, ultimately the stock market is a place where winners play, in the sense that in every industry, the top 1, 2, 3 players get listed. So this is, I think, a culmination of this long journey from demonetization, where unfortunately, in one sense, is the die has been loaded against the small businesses. So whether you see GST, RERA, whatever, but this is the final blow in a sense, and perversely, or whatever you call it, I think the stock market will benefit in the long term, because um, the market share shift both from unorganized and anywhere who's probably player number 5 to player number 100 in a lot of industries. So whether I'll just give you examples of some of these industries. I think whether you take real estate, whether you take aviation, you take textiles, you take pipes, you take paints, all of these industries, you're going to see, I think, a fair amount of consolidation of profit pools, which has happened in US. Actually, a lot of people, when they look at the stock market, they see it as a function of economic growth of the country, and that is true. In the very, very long term, nominal GDP and corporate profits will be closely linked. Maybe corporate profits can be plus or minus 2% of nominal GDP growth. But if you go to US, the last 10 years have been a bull run. In, although nominal GDP is not done that well, and I think that's the second big part which people don't focus too much on. Stock market is all about consolidation of profit pools. So while you need a baseline economic growth, that is, I agree, that's the most important thing. But you also, stock market will do well as long as profit pools get consolidated, and that is why I think over next 1 or 2 years, the market will do better than a lot of people who see the economy from the bottom-up perspective.
Thank you, Manish. So I'll summarize. So your general sense is that while the pain will be deep economically and for the markets, because you can buy good companies and the good companies will become more profitable, it's a good time and the market recovery will be strong. So that's phenomenal. That's actually really reassuring to our people. Nobody can predict the future. What we've been telling our customer, that Scripbox, is remain invested, have your asset allocation sorted out, be there for the long term, because in the long term, markets tend to recover. And in this case, if there's profit pool consolidation and great fund managers like Manish are buying the right companies, giving them more money to invest at this time is actually a great idea, because they can apply that money well in the companies they believe which will grow. Then the question which sort of I've been leading into is the question that investors are asking, and all our participants are asking: what should I be doing? Should I continue my SIP? Should I cash out? Should I wait for some recovery? Should I increase my commitment? I've got some money parked away? And broadly, what we have told people, and we just wanted to know what from you, that look after your asset allocation, make sure you've got an emergency fund set aside, make sure your fixed income portfolio is in decent shape, But apart from that, equity in the long term is the right place to be. So please don't cancel your SIPs and remain invested is what we've said. We'd love to hear your view. You're allowed to contradict us, please.
So I seriously believe that it's the time to increase lump sum investment in equities, obviously subject to asset allocation. So I think asset allocation, let's say someone had a range of 40 to 50% in equities or 20 to 30, whatever is the range. I think it's the time to be on top part of that allocation. The reason I think two, three things. One is, as I said, whatever way you think and read about this virus, I think from a time-wise perspective, clearly the economic activity will bottom out quite soon. So whether the lockdown lifts in 15 days, and we all know that nothing will go back 100% to pre-COVID. But clearly, I think things will start improving from there. Now, whether it takes 6 months, 9 months, 12 months, 15 months. See, if you do a cash flow discounting of a company, the first year's cash flow is actually only 2-3%. The value of a company should not change so much from a 1 year perspective, loss of cash flow. So in that sense, if you are patient enough, this is a pain which is very, you can't determine exactly, but if you take the outer boundaries, it's about, let's say, 1 year, 1.5 year max, and then things come back to normal. So in that sense, it's a very predictable kind of thing. The second is, as I said, it will lead to a lot of shakeout of big players in a lot of industries. And in a way, the 5 year down EPS of good companies actually has gone up because of this. So maybe without this, whatever EPS they would have done, I have a feeling that some of the leaders will actually do a better EPS now after this crisis, purely because the pricing power and the market share gain which they'll get, that would not have happened with this downturn in a sense. So I think we have to remain calm. A lot of people are focusing on sectors where demand is collapsed for next 6 months. But I feel that some of these sectors actually are the sectors you should look at because finally there is a certain demand which will come back, and B is the profit pool getting consolidated effect that might be more than the 3 or 6 or 9 months pain you're seeing. So obviously you have to calibrate this. These are slightly risky companies. So maybe you have to spread them across a few sectors because it's very difficult to visualize how consumer behavior will change after this. So some people are saying that the airline travel volume will never come back till 3 years or 2 years. Maybe it is, or maybe after 6 months we'll all forget and travel. Very difficult to figure out what will actually happen. Some people are saying going out to restaurants will take, some people think it's 3 months problem. Some people think it's a 24-month problem. So I don't know the answer. All I'm saying is that diversify the bets in a portfolio. But even if we get some of these contrarian kind of ideas right, I think we'll make a lot of money.
Thanks, Manish, and that helps, Rod. So we get to ask this question for ourselves, and from a Scripbox perspective, we have a very strong philosophy that trust the professionals. So we really don't try to guess sectors. We don't really try to guess mid-cap, small-cap. We believe in an asset allocation. So there are a bunch of questions in the chat window which are asking us which company should we buy, which sector should we buy. And I think Manish answered that very well, that the professionals know it best. Leave it to them. They know how to take care. That's the idea behind Scripbox, that we are here to represent the fund managers and represent you equally strongly. So we trust them to do their job well, and they've done it phenomenally well so far. So they'll know the companies to buy. And that brings the question to you. What is your investment approach at Nippon? I mean, and broadly in the equity side? Is it sector specific? Do you look at companies? Do you believe this is a great time to be buying because great companies are available at a low valuation? And what do you expect over the next couple of quarters in terms of result season? Because it's going to be pretty dismal.
Yeah, yeah. So the way philosophy we had at Nippon, if I were to talk from a CIO perspective, is that frankly we don't believe in one single style. So we have about 8, 9 fund managers. We don't necessarily recommend that you be value or growth or you be thematic or you buy only high quality companies. We believe that every business has a fair value. And what we're focusing a lot is to invest in very detailed and insightful research, which will ascertain the fair value of that company over the long term. And we will own what we think is below fair value. Now, it could be what is called a cigar butt investing, that there is no growth, but it's trading at 0.3 time book with a reasonable ROE. We'll still, some of us will buy it. Some fund managers may not touch it because there's no growth. But we're fairly clear that every business has a fair value. The job of the research team is to ascertain the fair value to a certain extent based on certain assumption. And different portfolio managers will construct portfolios differently. For me, I'm typically a growth at reasonable price kind of investor predominantly. But again, if something is 0.3 book at 15% ROE, I will not let that go. So if you look at the growth portfolio which I run, it has predominantly growth companies where we broadly think that 4 verticals: financials, consumer discretionary, healthcare, and technology is where long-term growth happens both in the stock market and the economy. So a lot of our portfolios in those 4 verticals. But again, at the same time, we have a bit of utilities which are trading very cheap, special situation, etc. So we are not of the type who will say that we will buy only companies with very high ROE or dividend yield or which are growing very fast only. So we have a set of different fund managers following different styles.
Lovely. The other question which we see, what we do at Scripbox on an annual basis, we monitor our portfolio regularly, is that we have a basket of recommended funds. And obviously Nippon India Growth Fund is one of our basket of funds which we recommend. When we do an annual review, we typically in an asset class or a subcategory, we recommend 2 to 4 funds. And based on our algorithm, we'll say, stop investing in this and start your new SIP in the next fund. Now, this is a periodic review. The question which our investors have, and I'd love to hear your view, some people believe in the fill it, shut it, forget it kind of category, invest, leave it for 7 years, leave it for 10 years. The other is that, hey, do a regular periodic review, manage your money, not actively on a daily basis, but on a periodic basis. What is your view on that?
So I think you should have a baseline asset allocation, and this is what I do personally as well. That roughly I have about 50% of my net worth in Nippon India Mutual Fund. So that is a kind of baseline allocation, but I think based on opportunity or maybe once or every year, I do switch funds. So for example, if small cap over last 2-3 years, the index is down 30-40%, I don't know the exact number, but obviously it has massively underperformed large cap. In absolute terms, it has fallen a lot. And bottom up, I can see a lot of small caps which are screaming buys at this point of time. Then I would switch some from, let's say, a balanced advantage fund to small cap, increase the risk a bit more. But that would probably be 5% of the portfolio. Rest would broadly remain the same. And I guess everyone has to find what is comfortable. But I like this approach that you have a band of asset allocation, like maybe equities is 40 to 50% for me. whatever is the base, let's say 20 to 30, you just have a range. Within that range, you can increase equities a bit, and you can also play within the fund. So one way of increasing, in a sense, allocation to equity, although technically or not, is if you move from large cap to small cap. In a way, I think you are basically leveraging yourself to equity a bit more. So I think I don't change the asset allocation proportion too much over time. But yeah, I think it's good once in a while to take the opportunities and move from one type of fund to another.
Thank you. I mean, that really does endorse what we do and gives us a lot of confidence that somebody with your credibility is telling us that this periodic review is important. And just to clarify to our customers, when we do recommend sort of buying a new fund in a specific sub-asset class, we are not telling you to exit the old one. We still believe it's a good fund. It's just that the other fund probably has a higher chance of performance in the next few quarters. We will tell you to exit the old fund at some point in time when it's tax efficient, when the exit loads have disappeared. So it's not that we'd like you to like drop it immediately. It's just that there's a better fund available for your future investments. That's the philosophy we follow at Scripbox. A couple of last questions, Manish. One is about what do you think the government should do? I know this is a large loaded question in terms of the economic stimulus to make things happen. And if it does do a lot in terms of fiscal deficit going up, what is your outlook on inflation?
See, I think, and I have a bit of a strong view on this, is that, first of all, India has been worrying about inflation a bit unnecessarily, I think, for the last 5 years. So in general, we've been too hawkish to my mind, because if you see the real rate in India over the last 5 years, it's typically been somewhere between 200 to 400 bips, which is much more than what any other economy in the world is running. So I think that inflation, as it has panned out, has turned out to be a demon of the past, and we've been a bit too cautious to my mind. Secondly, I think it's a very tricky dilemma, but I would shoot for actually blowing the fiscal and spending a lot of money. Now, I know there is a risk of a rating downgrade and currency depreciation, but I just feel that this kind of extraordinary situation which we are in, a lot of poor entrepreneurs will lose the work of a lifetime for no big fault of theirs. I'm actually a bit concerned why the government has not done enough to my mind now. I hope that something will come next few days, but I do think that so one thing I think they should do is that they should actually fund interest and wages. Now, wages are a bit difficult to do operationally, but I think interest is very easy. Like what I'm thinking is that let's say there's about 90 lakh to 100 lakh crore is the advanced side of the banking system, the entire loans. And you say that exclude the AAA and AA and exclude the agri loans, then maybe there's 30, 40, 50 lakh crores, whatever is B, triple B, single A. And you say that for 1 or 2 months, the government will pay the interest, because those are the guys who are at risk of going under. And there's a very force majeure kind of stuff. You don't want the small textile firm, the small paper plant to go, because I'm sure that but very few of these businesses can run without zero sales for 1 or 2, 3 months. They will accumulate too much debt, and probably the business will go down, which you don't want to happen. So it may cost maybe 50,000 crores or something, but I think it will be money well spent in the long term.
Thank you very much, Manish. I think we're probably just about out of time. just to consolidate, just to sort of reiterate what Manish has said and what we at Scriptbox say. Believe in your asset allocation, remain invested, trust the fund manager. This is a good time to, not a bad time to be investing. So if you've got spare funds and your asset allocation is on order, yeah, just trust the asset allocation in the, I would say, in the Scriptbox portfolio. We do have a lot of science behind what we do. Let the asset allocation take over what you do. Don't look for sector specific things. The fund managers know that very, very well. And thank you. I hope the government is listening somewhere along this, Manish. And we do get the fiscal stimulus. As entrepreneurs, we believe we're doing an honest job of looking after our customers and our employees. And we'd love to obviously be around for the long term. So anything the government does for everybody would be phenomenal. And your final words, Manish. Thank you very much from our side for actually taking the time out in this difficult time.
Thank you everyone for your time.
Thanks, Manish. Thank you very much. And thank you very much, all our participants. We have a few questions that are very, very fund specific. My team will get back to you with specific answers on why we selected a particular fund. And believe me, we select 12, 14 funds and now nearly 20 funds across different asset classes. We won't always get it right every time. We are here for the long term. So believe in the process for the long term. Don't look for short-term performance every day, every quarter. If you believe in equity, like he said, the 170 became 2 lakhs. Let that happen to you too. And to many more 2 lakhs to each of our customers. Thank you very much and be safe, guys, and everybody be safe. And thank you for being Scriptbox, for trusting us with your money. God bless.